Hey everyone, welcome to another episode. So today we're going to be talking about reserves and contingency planning for your Colorado Springs rental portfolio. So my name is Chris Lopez. I'm one of the co-hosts on this podcast. And this presentation is actually put together by Jenny Bayless, who's the other co-host and also runs our Colorado Springs investing division. And the reason we put this together is Jenny and I have a lot of fun conversations about real estate investing. I kind of share my thought, she shares her thought. We have lots of overlap, but definitely some different nuances there. So she's presenting how she, looks at risk, looks at managing expectations, and find that right balance of, maximizing long-term wealth while making sure you don't lose it in the short term. And an interesting thing I'll note on here that I find interesting as I talk with Jenny is her background is definitely numbers oriented. In her previous life, she was a CPA. So she's got a very analytical approach and knows the numbers and is just very savvy with numbers. Jenny, how's it going?
I'm doing great. How about yourself?
Doing very good. I'm excited to see this because I was supposed to review this presentation before we went live and hit this podcast. But life got busy, kids got sick, that did not happen. So this is going to be fun for you to explain to me and the guest on here. And hopefully I won't ask too many questions as you jump ahead, or if I jump ahead.
Absolutely. All right. So yeah, I thought that this was an important topic to touch on because a lot of times we get excited about what real estate has to offer, which I'm totally on board with. But, the reality of the situation is that there are risks involved. And I think that it's really important to just kind of be cognizant of them and see what you can do to protect your own portfolio. So that was why I wanted to put this presentation together. So basically starting off, when I began my investment journey, I had a very micro level view of what I would consider a worry for a landlord. So what if I get a call at 2 a.m. because a tenant clogged the toilet? What if
That's like the classic worry.
Yeah,
2 a.m.
exactly.
phone call.
And
How many
then
of those have you gotten?
Zero. Yeah. You know why? Because this is probably another good topic of conversation, but we actually provide all of our tenants with emergency procedures. So, if things happen in the middle of the night, who to call and what to do. So we don't get those calls. You know, other worries that people have, tenants destroying your home. Obviously, if you properly vet them, that's mitigated. But yeah, none of those things really kind of concern me. Obviously, they're going to impact my bottom line, but in the grand scheme of things, I noticed that as we developed and grew our portfolio, my worries began to evolve to a macro level view, things that I couldn't control. So what if there's a market crash? What if there's a surplus of rental units on the market? It just kind of expanded to beyond my control and to much bigger issues as time went on.
And was there like a certain trigger that caused you to kind of worry, stop worrying about the day-to-day, but more worrying about like the bigger picture grand scheme? Like what was the tipping point for you, or do you know?
Yeah. So it actually happened when, so every year at the end of the year, my husband and I go over financial goals and we take a look at, our finances and everything. And when I saw how much we owned in real estate, it was like, wow, that's a lot. I don't want to lose that. So that was kind of the tipping point for us.
That makes sense.
Yeah. So now that we've created a reasonable size portfolio, those are my top worries. So what we went through is, when I started freaking out, once I saw all that, we wanted to go through and identify what risks there were, and then taking an approach to mitigate those risks. So we actually developed a 3-tiered approach to reduce my worrying related to our rental portfolio. So the first one is vacancy. So what would happen if I had to rent at a lower rate to get somebody in my property? Second one, expenses. What would happen if I experienced a lot of CapEx and repairs during this time of trouble? And then the third layer is equity. So if items 1 and 2 fail, what would happen if I had to liquidate our real estate holdings? So we've been in a period of growth for the past decade, and it's really easy to get caught up in the idea that real estate is infallible. But I think that it's important to take a step back and look at all this.
So I want to, so, so for your, I'll say like decision-making process, and that's the right word, but like for the way you were kind of able to identify the issues,
Mm-hmm.
because this is what I do. And I like worry about things or, have concerns. I try to say, hey, cool, here are the 1, 2, 3 things that can go to like worst case scenario. So yours was like layer 1 was vacancy. What if we
Mm-hmm.
have higher vacancy and lower rents? Number 2, what if we have a ton of just repairs and CapEx expenses at the same time?
Mm-hmm.
And then third is, what if just the real estate market goes to crap and our investment's completely wrong? What do we do if we have to sell? That's
Yep.
kind of like your tiered thinking.
Exactly.
Okay.
Like basically if we consider our our rental portfolio in sort of a bubble. So, if we had to walk away with zero, but not impacting our personal finances otherwise, that's kind of worst case scenario for us. So,
And
um,
I know a lot of people can't see the PowerPoints. We do have all these notes on the show notes. Um, but your disclaimer here is this presentation will address how you addressed to counteract these worries so I do not lose sleep over this, so you can sleep over other things. So,
exactly.
and that's one of my litmus tests. I've, if I lay awake at 2 a.m. worrying about stuff, I'm like, you know what? It's not worth it. And as a total note on here, as a total side note, Jen and I were talking before we recording this podcast. Her 6-month-old daughter is teething right now, and she did not sleep much last night. My 3-year-old toddler had some stomach bug last night. I did not sleep much, so we are chugging coffee. If we're not quite as perky or ever A game on this podcast, that's our excuse.
I like the disclaimer. All right. So layer 1, vacancy. I know we talked about this in the out of state versus Colorado Springs podcast, but vacancy is absolutely a giant profit killer. So every month that your property is vacant, you have to absorb all the costs, the mortgage, taxes, insurance, repairs. It adds up real quick. So something that I looked at is how low can my rent go?
Hey, sorry. Can I ask you a
Yeah,
random question, Jenny?
absolutely.
Because I've talked with investors about this. I don't have my mind made up yet, but some people say, hey, you don't want to buy single family homes because if one goes vacant, you're absorbing all the cost. That's why you
Mm-hmm.
should buy multifamily, because if you have 10 units and one goes vacant, you still have it. So I know you have a lot of single families in your portfolio. When you look at that, like, what's your discussion of that? Do you look at everything? Like, since you have a lot of single families, if
Mm-hmm.
one goes vacant, do you look at that as like a global portfolio and like, hey, cool, I'm still have one vacant, my other 8 properties are paying rent? Or do you isolate things in silos? And would you compare that differently than like one multi in terms of like vacancy and income?
I look at everything as a portfolio wide situation. So if 1/8 of my portfolio is vacant, that I kind of treat it as one unit in an eightplex.
Okay.
Yeah, that's how I look at it. So something that I consider when I was evaluating this, the risk management is how low can I get my rent to cover everything? Can I sustain a 10% drop, a 20% drop? Because I want to be most competitive. So in a time of crisis, I would want to have the best property for the best price so that my property is the one that what I would assume is a smaller qualified renter pool will want to rent. So these are considerations that I take into account when I purchase a property. Also, as well as if I'm cash out refinancing a mortgage, because assuming that all else is equal, the interest cost is going to go up. So my expenses would increase if I do a cash out refinance. So for that, I consider this the first line of defense. If I have a qualified tenant paying all or at least the majority of my expenses, even though I won't have cash flow, I'll at least not have to reach into my own pocket to pay for costs associated with holding the property.
And when you run models, do you actually have like a stress test for dropping 10%, for dropping 20%? Do you get that granular?
No, I don't.
Yeah, I don't either. That's why I was
Yeah.
hoping you did. That way I could piggyback off of you, but
No. So then the second line is expenses. And I know Chris and I have talked about this on a past podcast, but I strongly feel that when in times of economic stress, when rents are low, vacancy is high, Murphy's Law will inevitably make sure that your furnaces and water heaters will break during
that
this
is
time.
true.
so so I really feel that it's really important to have a savings account that we maintain 6 months worth of expenses per property, and at no point does this ever dip below our designated number. And if it does, I'm reaching into my personal savings account to replenish it. Maybe I'm not going to go on a vacation or something like that. It's that important, and it's for emergency use only.
So I'm curious, and so like the way I have my bank account structured is I have a separate, well, some are checking, some are savings account for each property. They're all just pretty much online accounts.
Mm-hmm.
And I keep right around that 6 months mark. And that's my rents go into there, my mortgage payment expenses come out of there. Do you use one account per property, like your operating fund and reserve fund, or do you actually keep like two separate accounts per property, one for operating and one for emergency?
So we have checking accounts, and then of course our escrow accounts for security deposits and everything. And we have all the um, rents coming in and mortgages coming out of the checking account. And then each month, I actually take 1/3 of our residual cash from our rents collected minus the mortgages and put that into a savings account. And everything goes into one single savings account.
And so do you have separate checking accounts per property then?
I have them grouped.
Okay.
Yeah,
So you have a few properties per checking account and then one master savings account that's all the properties times 6 months.
exactly.
Okay.
Mm-hmm.
It's so interesting why you do it that way.
I don't know. I think it's just the way
Yeah.
my mind functions because, yeah, I operate things on an individual property basis. I like to be very efficient per property, but I look at things in the grand scheme of things as a portfolio, if that makes sense.
Yeah, it does. And this might be again. I have everything separate because it makes my accounting easier. I'm very
Okay.
bad at like keeping ledgers and I've got 3 accounts in here trying to figure out, because what my concern is for myself and a lot of clients I've advised on here is and I think you're obviously different with your CPA background, Jenny, is that it's easier. Oh yeah, I got like 6 accounts in here. Like, oh yeah, I have enough money to cover everything. I think it's a lot easier to get loose with the numbers. You actually don't say, okay, 6 months for this property times 6 months for this property times 6 months for this property adds up to this total in this checking account. That's my concern.
Mhm.
I keep everything separate.
Okay. Yeah, I think it's probably how how you think of things and how your brain
Yeah,
functions
it's just
for an
interesting to me,
organization.
like the psychology of it.
Yeah. Hey, whatever works, right?
Yeah. So
As long as it's somewhere.
you group them. And is there any like method to the way you group properties? Is it location, property type, or just hey, properties 1 through 3 are in checking count 1, 4 through 6 are in checking count 2?
Yeah, so it's grouped based on, so my husband and I split who owns what so that we could maximize the number of mortgages we could take out. So it's grouped based on us first, and then it's grouped based on location.
Okay.
Yep. So no, real good rhyme or reason of it, but it's just kind of how we organize things. um, so since we actually, all of our mortgages don't have escrow, we work with a local bank that allows us to not escrow our taxes and insurance. That's kind of my nexus for why I take in the rents, pay out the mortgage, and then at the end of the month, I put 1/3 of the residuals into that savings account. And then that'll also be used to pay out taxes and insurance when they come up. So it's just kind of our method of doing that. But at the end of the year, in theory, we should end at our original 6 months expenses for our emergency account.
In reality, is that what happens?
Not usually.
Yeah.
It's usually a little up, a little down. So we're still trying to figure out the exact, percentage to put in there, but it's hard just because everything changes. Expenses can go up. Just this year we refinanced 3 properties, so that's going to make things different. So it's just kind of taking a best guess and erring on the side of caution is kind of how we approach it. So that's really our second line of defense. So the way to shield against the expenses with either less income coming in or no income coming in is cash reserves. And I did just want to clarify that this is only for a real estate portfolio. So my family also keeps 6 months of cash reserves for personal expenses as an emergency fund. And then these 2 emergency funds accounts for rental and personal are in addition to just our regular savings accounts.
And your regular savings account, to make sure you understand, so you've got your real estate emergency fund, your personal family emergency fund,
Mm-hmm.
each about 6 months times expenses, and then you just have a regular savings account. Is that what you use to fund, future real estate investments, stock investments, things like that?
Yep, future
Yeah.
real estate, vacations, fun stuff. So it doesn't always have to be so dire for that general savings account that we have. So then the third line of defense is equity. And your castle came out with a really interesting chart that showed housing appreciation rates during the past 6 recessions. And I think it's really important to point out that obviously, past performance doesn't dictate future results, but during 5 of the last 6, Colorado Springs actually appreciated during those recessions. So I think that's kind of interesting to note. But during the housing crisis, the housing mortgage crisis in 2007, Colorado Springs went down in value about 3.8%, whereas nationally it went down 19.7%. So that's kind of leading into my next point for having an equity buffer.
So I want to stop and talk about this because I've referenced this chart in the past, and actually have not looked through the latest data your castle just published. And so you said 5 out of the 6, because this is including so far data from the 2020 recession and the COVID pandemic recession.
Yeah. Mm-hmm.
And shows Denver increased at 1.5, Springs 1.5, Fort Collins based at 1%, and National at 4%.
Mm-hmm.
And the thing I always like to point out is, these past 6 recessions, only one was driven by the actual housing market, which was 2007 with all the bad loans and Wall Street lending. All the other ones were not housing driven. So generally, I look at it as long as that housing driven recession, most likely we can expect appreciation.
Exactly.
That's my attitude.
I feel the same way, that if, like you said, if something's literally driven to a recession via the housing market, I should hope that that'll be the worst that we see during our lifetime. So that's kind of what I use as the benchmark for worst case scenario. So just to kind of back up a little bit, I know we've mentioned in the past that I've used the Burr method to grow my portfolio at a pretty quick pace. And then, of course, in a couple of cases, I've cash out refinanced some of those properties that we previously did a cash out refinance as part of the Burr to reinvest that into additional assets. But just to kind of give everyone a high level point of view from our portfolio management, is that we do have a rule that we want our portfolio wide loan to value ratio to be at 65%. So I know that some of you guys are thinking, well, you need 75% probably to do a cash out refinance. We have some properties at 50% loan to value. So all in all, our portfolio wide loan to value is at 65%, which would warrant a 35% drop in value across the entire portfolio to become underwater.
And so do you actually track, excuse me, do you actually track like on a spreadsheet or something, like, the value, the estimated value, compared to the current loan balance and compare them all?
I do.
Mm.
Mm-hmm.
How often do you update that?
Monthly.
Really?
Yeah.
Even with like the estimated values on the properties themselves?
No, so the asset portion of that with the estimated value, which it's not historical value or anything, but we just go ahead and do fair market value for that. We will update that probably twice a year, or if we get an appraisal, we'll update it at that point. But the loan portion on our liability section, we update monthly.
Wow, that's impressive.
Yeah, we like to keep a close eye on things. It's kind of fun to take a look at it and see how it changes.
And do you include your primary residence in this 65% LTV, or is that excluded from your rental portfolio?
So we do have 65% LTV in our primary residence, but it's completely excluded from my rental portfolio analysis.
Okay.
If that
And do you want to
if that
maintain
helps them.
your primary residence at 65% LTV or lower? Are you kind of use the same rule of thumb on there as well?
So we didn't go into it deliberately for our primary with the 65%, but we wanted to make sure that we were still within the conforming loan limit, which for El Paso County, it's a little bit lower than up in Denver. So we just put enough cash into it to get our loan to that point, which happened to be 65%.
Oh,
So
okay.
that's kind of where we came up with that. But no, it's just kind of ironic that it matches our rental property percentage.
That is, but makes
Yeah.
for a good podcast.
Yeah. So just kind of, going back to the prior slide, which I guess if you're listening to, you can't see, but the one that Chris and I just described, historically during the worst recession to date, which was literally caused by a housing mortgage crisis, the asset values dropped about 3.8% in Colorado Springs and almost 20% nationally. And as we mentioned, all of the recessions, Colorado Springs values rose. So of course we can't, assume that the past is indicative of the future, but this is my absolute final line of defense. So if I'm encumbered by vacancy and I'm not able to pay the monthly bills via the rent, all my reserves are depleted. The economy would have to be in an even worse position than it was during the 2007 crash for me to walk away with absolutely nothing. And that's based on the assumption of a 20% drop in value plus 10% selling costs. I would walk away with about 5% equity in cash from closing. So, enough to buy a Happy Meal at the end.
So you wouldn't sell because prices dropped. You would sell if your cash reserves are nearing zero and rents are still just in the tank,
Zero.
right?
Yeah.
Okay.
It would be dire circumstances.
Because you don't care about the price necessarily. You're just saying, hey, if I can't pay the bills anymore, I will sell to make sure I don't go to short sales or bankruptcy then, right?
Exactly.
Okay.
That's the assumption that I've done everything that I can to keep it afloat, and I just can't keep it afloat anymore.
Yeah. Okay. That makes sense.
Yeah. I definitely would not sell if everything was renting just fine and the values happened to drop. I would just hold it because it's
Just ride
operating
through it.
fine. Exactly. Yeah.
Yeah.
If it's operating fine and I'm not feeling the pain from that. So just a couple final thoughts. I know some people might be thinking, okay, well, what if I'm doing a nomad or a house hack strategy and I only have 5% down? My thought is that, well, first off, these are just my worries and my compensation for my worries. But, I would almost suggest maybe just pump up your cash reserves to balance it out a little bit more. You don't have to follow this to a T. This is just personally how we operate. But just maybe think about having extra extra cash in your bank account for that. Or on the flip side, if you have 2 years of cash reserves and 40% LTV across your portfolio, that might be a little bit too much. It's really important to understand your personal and market conditions, but this might be too conservative. So I think it's important to kind of balance those out.
So I always have this internal debate, and we have this debate sometimes too, Jenny. Um, as accumulate more rental properties, we both have our realtor businesses and all that stuff. So obviously, keeping appropriate cash reserves for businesses, for real estate, for emergency funds, a good problem to have. It starts accumulating to a pretty significant cash amount sitting in the bank.
Mm-hmm.
And we all know banks pay very low right now in savings because we're getting really cheap mortgages right now. So that's the trade-off. But do you always just park at cash, or are you putting some into like CDs or 60-40 stock bond split to get some gain? Like, what's your thoughts on that?
For our savings, for our reserves for personal emergency, is just in the bank. I like to keep it simple.
Yeah, and same thing for for everything, for real estate, personal, everything. It's just in the bank.
Mm-hmm. Yep.
Yeah, that's how I feel too. Because like I don't know, I had money in businesses in the 2008 meltdown, and had the roller coaster there, and I have very vivid emotional memories about that. Every time I think about, maybe I'll go invest into like a moderate risk, a stock bond, we'll say a 50-50 split type thing. I model, I'm like, okay, cool. I might make an extra like $5,000, $8,000, $10,000 a year, or $20,000 a year, an extra 5-7%. And every time I look at it, I'm like, you know what? A couple extra bucks a year is just not worth that trade-off. That if things drop, I could be in a bad space.
Yeah, I completely agree.
And I say this because I've worked with a lot of clients. I've talked to clients and other investors that they were not in the adult job world when the 2008 crash happened. And as everyone knows, the stock market, real estate market's just been on a run to the last year or so, especially the stock market, and everything's invested in stocks and bonds. And people tell me that. I share my 2 cents, but it scares me because I think, oh man, they're getting those returns. But I'm like, what if when that happens? And I've been through that, and that's what just scares the crap out of me.
Yeah, I agree. I don't think that squeezing an extra few dollars out, opportunity cost wise, I guess, for the almost insurance of having it just be static, to me is, I don't know. I'd rather just know exactly what I have and, collect my 3 pennies a month on it or whatever it is.
And that's the word I use. I call it insurance.
Mm-hmm.
It's my insurance, and that's a very different silo than investing.
Yep.
So I'm glad you used
I
that word.
agree. So yeah, I think just to kind of reiterate, I think that even in times of offense, which is building your portfolio, it's important to ensure, with the E, your defense, which is reserves, making sure that that's strong. Don't over leverage your real estate, both, and I use that in terms of debt and operations. So full disclosure, when we were doing a lot of our BRRRR properties, I'm not going to lie, there were times where we were skating pretty dangerously thin to being overextended in terms of, our abilities to get everything done at the same time. We were scrambling to get multiple properties refinanced at the same time too, which is kind of a little nerve wracking. So, it ended up working out for us, but I like taking a step back. I don't think I would have done that again. So I think that's just kind of important to understand also. And just kind of what we mentioned, it's easy to get caught up in the excitement of your rental properties when things are going well, but you always need to make sure that you're prepared to weather the bad times so that you don't lose everything that you worked so hard for, because that's just devastating.
Yeah, and my attitude, I mean, anyone that's talked to me more than an hour has heard me say this. It's a matter of when, not
Mm-hmm.
if. Things are how I was doing, and And for me, it's, hey, it might be, hey, the market goes down, but what happens if it's the stock market goes down, the real estate market goes down, you lose your job, your business goes sideways, your tenant destroys your house, and then 3 furnaces break. Just like, hey,
Mm-hmm.
worst case scenario. Obviously, like, it's a low probability, but it's one of those events that could, wipe you out. And that's always my focus. Is I'm not worried about, like, okay, cool, whatever, a unit sits vacant for an extra month. Or, I'm like, geez, I got to repaint the place, or this stupid brand new furnace I bought 4 years ago, now it's out of warranty, just broke again. Like, I don't care about a couple $1,000s
Mm-hmm.
in the grand scheme, but what worries me is just like that low probability event that could, like, wipe me out. Because my philosophy,
Exactly.
as long as I can keep hold on to everything in the next 30 years, I should win at the game of life.
I completely agree. My brain goes to worst case scenario, and um, my husband is a statistician, and he's always like, well, the odds of that happening is extremely low, but if it helps you sleep at night, this is I think we're pretty weathered on that. So that's just kind of my thought also.
Awesome. Well, Jenny, this was very insightful. I learned a lot. And this is one of the things that, as we're launching this podcast, we just recently launched our firm as the Envision Advisors now. We're trying to go above and beyond just the normal, hey, here's a good deal. Here's how to go out there and analyze your property, but how to actually go out there and acquire a portfolio, but make sure you hold on to it and optimize it. And to really dive into these, deeper financial concepts. And I mean, let's be real, like, talking about financial reserves is not real exciting. It's not real sexy, but is a critical component to have, because there's a lot of people who are real estate rock stars in 2006. They lost everything next couple of years. The people that
Hmm.
didn't, that I've talked to, the main difference maker was cash reserves. That was the biggest difference in the world between the people that survived it, and the people that end up going, bankrupt and short sales, was cash reserves. So, like, understanding this, figuring out your risk tolerance, it is mission critical. I think Jenny thinks, if you guys understand, and that's the type of value we're also trying to help you go out there as you build your portfolio and hopefully, build it, acquire it, and retire in 15, 20 years type time frame. So, Jenny, thank you so much.
Thank you.